The Rebel Capitalist Show.
Everyone knows you from the Dragon portfolio, the famous Dragon portfolio. And what I've been thinking through lately, and you can kind of explain this to us, is in the Dragon portfolio, we've got the left wing as a deleveraging and the right wing is a deleveraging. And I think everyone can agree on FinTwit, let's say, that we've got to have some sort of deleveraging. The debts are just too big. The question becomes, do we get it through deflation or inflation? And that takes us to this report. And then maybe once you can describe that report, you can tell us what your views are for the next maybe 2, 3, 4, 5 years for the rate of inflation and what we're seeing with the CPI right now.
Yeah, you got it. So to kind of recap this concept for your viewers, and this is obviously a short form from what's in our papers, which are available on our website at www.artemiscm.com. But the concept is when a country, when corporations, when individuals are massively over-indebted, and we are massively over-indebted.
Right.
Both on a public government level, we have the highest deficits to GDP in American history outside of World War II. Corporate debt as a percentage of GDP at all-time highs, unprecedented levels at all-time highs. So we are massively indebted as a country. Corporations are massively indebted, and when you have this level of debt, there needs to be a time for debt jubilee in some fashion. Now, if you look across history, and anyone who's read my work knows that we're students of financial history. There's two ways to get rid of excessive debt. You can have a major deflationary collapse where you default on that debt. A great example of that is the Great Depression.
Right.
In that scenario, you had markets drop over 80%. You had volatility. The volatility we experienced in March, imagine experiencing plus 40% realized vol for a decade. That's incredible. And so that's the 1930s for you. Now, there were periods in the 30s where markets rebounded tremendously.
Right.
80% rally. Like for anyone who says, "Oh, we're out of the woods," in the 1930s, you had 80% rallies off of lows, and then it continued collapsing later on. So it's interesting to keep that in mind. Well, that's one route. You can default on your debt, wipe the slate clean. But the problem with that is mass unemployment, tent cities, all these other problems. The other way, the stealth way that you can default on massive amount of debt is you can not devalue the debt, you devalue the fiat. You actually devalue money itself.
Right.
And under that's what we call the right wing of the hawk, or the right tail of the return distribution. Of course, the most extreme examples of that would be hyperinflation. The German hyperinflation, the Brazilian hyperinflation. But there's actually a fantastic proxy for that, for maybe a potential reality for the US is the 1970s. Because in that scenario, what occurred is that Nixon devalued versus gold. We had the Nixon gold shock, and we fully delinked the dollar versus gold. And at that point, inflation rose all the way to the mid-teens. And in that scenario, what occurs is that instead of defaulting on your debt, you're actually devaluing you're gradually cutting away at the notional value of the debt through inflation. Of course, this is equally damaging because, if you look at the 1970s, the stock market kind of moved sideways for a while and had a drawdown of about 30%. But if you look at what occurred to the stock market during that decade after inflation, you had an over 50% loss on your portfolio after you took into account inflation. If you're making 5% in the stock market, but inflation's at 15%, you are losing money.
Right.
This also explains part of the generational challenge. There's a generational fight going on. Because if you're someone who's older and you already own a home, you already own assets, what you're going to want is you're going to want the government to bail out financial markets. That's the thing through monetary policy. Well, if you're a young person who doesn't own a home, who has massive amounts of student debt, you want the government to bail out markets through fiscal policy, print a ton of money, give you that money, or issue a lot of debt, give you that money. You don't care about inflation because you have no assets. You only have debt. And if you only have debt and no assets, inflation has benefited you. So I always joke about this with my parents. They graduated from medical school. They're both doctors in the early 1970s, or actually kind of middle of the 1970s. And what a great time to have a ton of debt, because you have no assets and you have tons of debt, and your debt gets eaten away by the inflation.
Right.
Across history, these are the two wings. These are the two ways out of the debt cycle, and both destroy wealth. Both are complete ways of destroying wealth. So the question at the end of the day, and the question that we try to answer through the Dragon portfolio, is we've only existed in the last 40-year period, really starting in the early 80s to now, has been one of the most unprecedented periods of secular growth in history. We started out with interest rates all the way up, 10 years all the way up at 16%, and we go all the way down to near zero, right? At the same time, these baby boomers, huge generational power enters into the economy. They enter their prime spending years. You have globalization. The 1970s, we had a very low debt level at that point in time, relatively speaking.
Yeah.
So it wasn't that damaging. And so there was a tremendous amount of debt accumulation. And starting in the late 70s, taxes were actually already quite high. So we were able to lower taxes and deregulate markets and deregulate the economy. So this pro-cyclical cycle of starting out with low debt, high inflation where rates can be lower, positive demographics, positive exporting our inflation using globalization as a tool, has resulted in this incredible 40-year period of unprecedented price growth in stocks and bonds. And the entire world is operating on this idea that will repeat.
Right. That's right. Everyone's portfolio is set up based on the last 40 years being the next 40 years.
Exactly. Everything's looking in the rear view mirror.
Mm-hmm.
So in my paper, I talk about this concept, and you've done a wonderful job articulating this in your podcast and some of these ideas in your show. But if you expect the next 40 years with the last 40 years, you're going to be in trouble.
Right.
You need to prepare for this secular decline. The problem at the end of the day is you don't know how the secular decline is going to occur. You don't know if it's going to be deflationary. You don't know if it's going to be stagflationary. And the truth is markets aren't going to determine that. Policymakers are. So you almost have to read the mind of policymakers. So we have this ethos at Artemis, which is, and the main idea is do not fear, do not predict, prepare. And so the concept of the Dragon portfolio is looking across 100 years of financial history. What portfolio is able to profit off of the growth, but also profit off of the left and right tail of the regime distribution? A portfolio that can profit in stagflation and a portfolio that can profit in deflation.
Right.
We tested every conceivable portfolio and came up with this answer. And this empowers people to not have to predict. You don't have to predict in time. Maybe if you're Stanley Druckenmiller and you're a genius and you can figure out, you have that unique talent. But to the average financial advisor, to the average retiree, the ability to predict the winds of these changes are very difficult. You don't need to if you actually hold the right combination of assets.
Yeah, and that brings me to the topic of how important portfolio construction is. That so many people get hyper fixated on just trying to look around at just the shiny object syndrome and trying to determine what the price of XYZ is going to do. And they completely ignore how their portfolio works and how each asset in their portfolio plays off one another, and therefore what the probabilities are that they are financially successful over the long term. And I have such a huge advantage because I started off way back in 2000 playing blackjack, right at the beginning of when I was an entrepreneur. And it's just to train my mind to think in probabilities.
George, it's interesting what you said about blackjack, because when I was in my 20s and I was learning systematic trading, I trained myself on card counting.
Yeah. I did the same thing, but to train myself how to think better in business in terms of probabilities.
Exactly. Like I'm not going to go out and say that I was some expert card counter.
Yeah.
At one point, I could count a deck in under 30 seconds. But the point on it is to be able to think probabilistically.
That's right.
People learn that through poker. They learn it through blackjack. It's a wonderful tool to teach them.